Hello fellow traders, here's another of many videos where we'll be covering support and resistance levels on stock charts as well as pivots by a pajama trader.
Support, resistance, and pivots. Support and resistance levels are important technical analysis tools to help traders identify potential entry and exit points. Support is a price level below the current market price where buyers are expected to step in and prevent the price from falling further. Resistance is the price level above the current market price where sellers are expected to step in and prevent the prices from rising further. Pivot points are a set of technical analysis levels that are calculated based on high, low, and closing prices of a security. How to identify support resistance levels. Identification. Support and resistance levels are points on the price chart where prices historically reversed or bounced off of. Chart representation. These levels are typically represented as horizontal lines on price charts. Support level. Support is a price level where the price tends to find buying interest, preventing it from falling further. Resistance level. Resistance is a price level where the price tends to encounter selling pressure, preventing it from rising further. Market psychology. Support and resistance levels reflect collective psychology of traders as they remember previous price reactions at these levels. Trading strategy. Traders can use these levels to make trading decisions based on buying near support and selling near resistance. Breakouts. When the price decisively breaks through resistance or support level, it can signal a significant change in market sentiment. Dynamic nature. Support and resistance levels can shift over time as new information and market dynamics come into play. Identifying support and resistance. Repetition matters. The strength of support or resistance level is positively correlated with the number of times the price has interacted with it. Cumulative effort. Each bounce off the price level reinforces the notion that it holds significance in the market. Psychological impact. Traders tend to remember and react to the levels that have repeatedly influenced price movement, making them more influential. Higher confidence. Traders and investors have higher confidence in levels that have a history of holding, making them more likely to base their decisions off these levels. Self-fulfilling prophecy. As more market participants pay attention to these levels, they become more of a self-fulfilling prophecy as traders collectively react with prices approaching them. Breakouts more significant. Conversely, when a price breaks through a price level that held multiple times, it can signal more significant shift in the market sentiment due to the established history of that level holding. Using support and resistance levels to trade. Entry points. Traders can consider entering a trade when the price approaches a support level. It may indicate a potential buying opportunity. Exit points. Conversely, traders may look to exit long trades or consider shorting when the price nears a resistance level, which could signal a potential selling point. Risk management. Supports and resistance levels also help traders set stop loss orders. Placing stops below support or above resistance can help manage risk. Trend confirmation. When the trend breaks through a support level, it may confirm an upward trend, prompting traders to enter long positions. Conversely, a break below support can signal a downtrend, prompting short positions. Profit targets. Traders use resistance levels to potential profit-taking points for long trades and support levels while covering short positions. Confirmation with other indicators. Traders often combine support and resistance analysis with other technical indicators or chart patterns to increase the probability of successful trades. Flexibility. Support and resistance levels are not fixed, so traders must adapt to changing market conditions and adjust their entry and exit strategies accordingly. Backtesting. Historical price data can be used to backtest the effectiveness using support and resistance levels for entry and exit points to refine trading strategies over time. Here's an example of support, resistance, and pivot levels. You see the first level at 125.19 support, and then just above it you see 135.40 resistance. Above that you see 152.18 resistance and also a pivot point, as you can see it reversed a little bit after that. And then you see the 182.10 resistance level, also a pivot, because you can see maybe a couple weeks after that it falls over, and then you see in the later part of the chart it struggles to get past that level. A scenario on trading support and resistance levels. Step 1. Identifying support and resistance levels. Number 1. The trader analyzes the stock chart, identifies support level at 50, where the stock has continuously bounced off in the past, preventing it from falling further. 2. The trader identifies resistance level at 60, where the stock has encountered selling pressure and struggled to move higher. Entry point. The trader decides to enter a long buy position when the stock price approaches the support level at 50, believing the historical support suggests a potential price reversal or bounce. They place a buy order when the stock reaches 51, slightly above the support level, to confirm that the price is indeed rebounding. Stop loss placement and risk management. To manage risk, the trader sets up a stop loss order just below the support level at 49.50. This stop loss order will automatically sell the stock when the price falls below the support level, limiting potential losses. Exit point. The trader plans to exit the trade when the stock approaches the resistance level at 60. They believe that the stock may encounter selling pressure at this level. They place a sell order when the stock price reaches 59.50, just below the resistance level, to secure potential gains. Profit taking. If the stock price rises to the resistance level and breaks through it, a trader may consider adjusting their exit strategy, such as a trailing stop loss, higher, or waiting for further price action confirmation. Monitoring and adaptation. Throughout the trade, the trader monitors the stock price action, news, and other relevant factors to make real-time decisions and adjust the trading strategy if necessary. Using support and resistance for stop losses. Stop loss placement. Traders can place stop loss orders just below support levels when entering long positions. If the trade breaks below support, it can trigger stop loss, limiting potential losses. Risk management. Placing stop loss orders near support levels helps manage risk by defining a point to which the trade is considered unsuccessful, preventing excessive losses. Profit-taking levels. Traders set profit-take orders just before reaching support levels when in a long position. If the price approaches resistance, it can trigger the take profit order, securing potential gains. Profit protection. Take profit orders help lock in profits, and prevent traders from getting greedy or waiting too long to exit a winning trade. Confirmation of trend reversals. If the stock price breaks below resistance, traders may adjust their stop loss and profit take levels to account for potential trend reversals. Flexibility. Traders should adopt stop loss and profit take levels based on changing market conditions such as price volatility or new support resistance levels. Technical analysis. Combining support and resistance levels with other technical analysis tools can help traders fine-tune their stop-loss and take profit strategies for better risk management and profit maximization. Pivot points. Support pivot S1, S2, S3. S1, a level below the central pivot, providing potential support area. S2, a further level below S1, often considered a stronger support level. S3, an even lower level, typically the strongest support pivot. Resistance pivot R1, R2, R3. R1, a level above the central pivot, offering potential resistance area. A potential resistance area. R2, located higher than R1 and often seen as a stronger resistance level. R3, the highest resistance pivot, usually the most formidable barrier. Central pivot. The central pivot is considered the main pivot point, representing an average price level of the trading session. Traders use it to gauge whether the price is bullish above or bearish below relative to a central point. Trading decisions. Traders use pivot points to make trading decisions such as buying near support levels, supporting pivots S1, S2, S3 when the price is above the central pivot, selling or shorting near resistance pivots R1, R2, R3 when the price is below the central pivot. Central pivot can be used as a reference point for trend analysis and as a basis for setting up stop loss and profit taking levels. Intraday and swing trading. Pivot points are particularly popular among intraday traders, helping them to identify potential entry and exit points within a trading day. Additional levels. Some pivot systems also calculate additional support and resistance levels, such as S4 and R4, which are further from the central pivot and may be considered extreme levels in high volatile markets. Adaptation. Pivot points are recalculated as part of each trading session, making them adaptable to changing market conditions and providing new reference points for each trading day's activities. Pivot points overview. Pivot points are set as key technical analysis levels used to identify potential support and resistance areas in a security's price movement. Main pivot points. There are three main pivot points used in pivot analysis. Support pivot, calculated by subtracting the average of the high and the low prices from the closing price. Resistance pivot, calculated by adding the average of the high and the low prices to the closing price. Central pivot, calculated by averaging the high, low, and closing prices. How to trade pivots. Identifying support and resistance. Pivot points can help traders identify potential support and resistance levels in a security's price movement. The central point is a crucial reference point. Prices may indicate a bullish bias when it's above the pivot, while prices below may suggest a bearish bias. Setting up stop losses and take profits. Traders can use pivot points to determine levels for setting up stop losses and take profit orders. For long positions, consider setting up stop loss orders just below the support pivot and take profits near the resistance pivot. For short positions, set a stop loss just above the resistance pivot and take profit near the support pivot. Traders may initiate trades based on pivot points. For example, buying. A trader might buy a stock when it reaches a support level S1 if it reaches above the central pivot. Selling. A trader could sell a stock when it approaches the resistance pivot R1 if the is below the central pivot. Intraday trading. Pivot points are often used by intraday traders as they provide potential entry and exit levels within a single trading day. Additional pivot levels. Some traders will consider secondary support and resistance levels. Example, S2, S3, R2, R3 for more refined trading decisions, especially in volatile markets. Flexibility. Pivot points can be adapted to different time frames, from daily to hourly or even shorter periods to suit various trading styles and strategies. Monitoring and confirmation. While pivot points provide valuable guidance, traders should also monitor other technical indicators and price action for confirmation before making trading decisions. Risk management. Always use proper risk management techniques alongside pivot points to protect against potential losses. Setting stop loss orders is essential to limit risk. Continuous adjustment. Pivot points are recalculated at the start of each trading session, allowing traders to adapt to their strategies based on changing levels for each new trading time, day, and period. Conclusion. Support and resistance levels and pivot points are valuable technical analysis tools for traders. They help identify potential entry and exit positions or endpoints, set stop loss and take profit levels, and gauge market sentiments. Use this toolkit. While these tools are helpful, they should not be the sole basis for making trading decisions. Traders should integrate them into a comprehensive trading strategy that considers other factors like market fundamentals, economic events, and trend analysis. Stay informed and adaptable. Successful trading requires continuous learning and adaptation to evolving market conditions. Traders should also keep up with the news, market sentiment, and other indicators to make informed decisions. Risk management. Always prioritize risk management when using these tools. Set stop loss orders to limit potential losses and manage your capital wisely. Questions are welcome. If you have questions or need further clarification on support and resistance levels, pivot points, or any other trading related topics, feel free to ask. Subscribe for more insights. Stay updated on trading strategies, financial insights, and more. Consider subscribing. Share your feedback. We value your feedback. If you found this information helpful or have any suggestions for improvement, please share your thoughts. Like and share. If you found this breakdown useful, don't hesitate to like and share it with others who might find benefit from it. Remember, successful trading is a combination of knowledge, discipline, and continuous improvement. Don't hesitate to seek advice from experienced traders or financial experts as you develop your trading skills. Thanks for watching.